Over the last 3 years, we've experienced a bear market in equities at the same time as a major bear market in bonds. Let me add Vanguard's intermediate term treasury bond fund to the chart here for display and discussion purposes. The red line, we can see a peak to trough drawdown of about 15%. This has been one of the worst bear markets in the history of bonds, and it came at the same time as a bear market in equities, which is unprecedented. Historically, we as investors have been able to rely on the diversification value of bonds to kind of balance out a portfolio and to hold their value or increase in value a little bit while equities are in a bear market. And we saw this really pronounced in the lost decade of the 2000s. Bonds did incredibly well while equities got their ass kicked. But, well, as we all know, and if you're at this video, you've probably felt over the last 3 years that has not been the case. And it's pretty painful when these things both decline together. In quantitative speak, we would say shit hits the fan when correlation goes to one. And although correlation of stocks and bonds did not literally go to one, it did, kind of move simultaneously, which did not feel good. In this correlation between the two of them, or just the fact that they can decline in value, decrease in value, or go through a bear market at the same time together, has had a lot of investors considering just replacing the bond portion of their portfolio with conservative equities. That way they capture more of the premium on the upside. And yes, while the equities, will still decline and are still susceptible to drawdowns, you're still going to offset that by the value that you're going to get on the upside. So I wanted to take a look at that, in particular, compare two holdings of conservative allocations in equities, being defensive allocation of consumer staples, healthcare, and also utilities, to that of investing in high cash flow companies, which is now easily done through a couple different high cash flow ETFs that are out there on the market. Let's just start off by taking a look at the simple defensive allocation here. Consumer staples, utilities, and healthcare, all of them equal weighted and represented by the sector ETFs. And we're going to look at them back as far back as we can go to 1999 against the Vanguard Intermediate Term Treasury Fund and also the S&P 500. And I've ran the portfolio values on them here, which you can see. Portfolio 1 being our defensive allocation, compound annual growth rate at 7.53%, S&P 500 at 7.59, while bonds hang out back there at 3.56. Visually, we can clearly see that equities absolutely smoked the bonds, but that's not the case for about the first 10 years of this portfolio, or even a little bit longer here. Through the 2000s, we can see the red line being the intermediate term treasuries or bonds, for simplicity here, just absolutely smoked equities. Through the lost decade, we had the dot-com bubble, the great financial crisis, equities got their ass kicked, bonds did very well. But as you increase the time horizon, we can clearly see equities do very well, much better, clearly outperforming bonds, albeit they have a lot more downside and volatility, but over time, they do achieve higher returns. Right now, what's really interesting here is the defensive allocation actually did damn near as well as the S&P 500. We can take a look at their Sharpe ratios, which is a measure of risk-adjusted returns. Naturally, the defensive allocation, 0.53, had the highest, followed by S&P 500, and then bonds. I think the big takeaway here, though, is that the stocks, being the S&P 500, over time go up a lot more than bonds, but B, defensive allocations can generally, outpace bonds, or should naturally over time significantly outpace bonds, but can also keep up with the S&P 500 or be quite close to it, which is why a lot of investors are attracted to them for replacing the bond fund. Like, yes, they can have a drawdown. We see the great financial crisis, the defensive allocation went down about 34% versus the S&P 500's nearly 51%, still more than double that of bonds. They can have a drawdown. Their risk-adjusted return, Sharpe ratio, is still pretty high. So yeah, you have that downside risk, but you also have a lot of upside risk, which makes holding equities instead of bonds look very favorable. Now, interestingly enough here, the defensive allocation did nearly as well as the S&P 500. I think if we cherry-picked a different time, a different period in time, we can see a different story. And let's just start by, looking at the 2000s. So we'll put that in 2009. Through here, of course, we see bonds did quite well. S&P 500, yellow line, getting its ass kicked. Defensive allocation does okay. Over this, what would be, 11-year period here, because we have 1999 included in this. S&P 500 only goes up 9% versus defensive allocation up 40% over that time period, and then you have bonds. Now, if we go to bull market days, let's just say, kind of 2010s-ish to present, we should see the S&P 500 outperforming quite a bit. And yeah, we do see that the total return of $10,000 invested in S&P 500 goes up to $50,000 versus defensive allocation $36,000, still substantially higher, outperformance than bonds. Right. So this, I would say this looks quite good. Now, what we're looking at here is just US based equities. So these funds that we have, obviously the S&P 500 is S&P based, or S&P 500 is US based, but the sector ETFs that we're using are US based. Let's just kind of shift gears here and look at it internationally. We should see about the same thing. And I have used iShare global sector ETFs for this comparison. And I've used a 60-40 breakdown of US stocks, international stocks, because I could not find a total global stock fund to represent things on here. But over time, as far back as we can go, when the sector funds were launched, 2007, since then, we can see the performance has actually been about the same, kind of, about what we're expecting based on what we know from the US holdings that we just looked at on the previous screen. Compound annual growth rate of the defensive allocation globally, 6.68% versus 7.1% for total global stock markets. Drawdown, 38.97%, still substantially higher than bonds, but not as high as, total global stocks. Now, one thought that I have here, and this is really hard to kind of break out in a video, is that while global stocks or international stocks, non-US stocks, have kind of been stagnant and going nowhere, I would venture to say that the defensive allocation in those markets has probably outperformed the broad market in those markets, which kind of says to me there may be some weird diversification value in this, right? Because when one broad market is going up, or declining, I should say, right? International stocks have been stagnant or declining. The defensive allocation in those markets is actually increasing. And this is really hard to quantify without having like a proper research paper on it. It would still be very hard to present in video. But I think there's some kind of weird diversification value going on in this that is almost harder to speak of, which would bring this global defensive allocation closer in total return to that of the broad market, right? And that's just my quick take on it, my anecdote on it. I think the big concept, though, that we should take away from it is that, again, they go up or increase in value much faster than bonds do and have a higher risk-adjusted return, making it good to, or considerable, I shouldn't say good, it's all up to you, considerable to hold the bond portion of your portfolio in this as equities. Now let's shift gears back to just US equities here, back on the screen with the US sectors for defensive allocation and S&P 500. And let's add a high cash flow ETF to this. Here, we are going to use ticker symbol COWZ. There's a couple others out there. Most of us know COWZ. That'll be the most recognizable, so that's why I'm using it. I don't intend to make this a promo about the COWZ ETF, but it is the simplest and most recognizable to use. It's also the oldest, and we have data going back to 2017. So we can compare the data now of the defensive allocation to that of high cash flow investing. And I should kind of take a step back here and clarify, COWZ invests in companies that have high free cash flow yield. So free cash flow relative to their enterprise value. All right. And let's just take a look at how that's performed since 2017. Portfolio 3, which would be, I believe, the green. Oh, no, portfolio 3 would be yellow line right here. Defensive allocation, blue line, green line, S&P 500, red line, pesky old bonds on there, which I think, if you're at this video, you're probably vibing with my tone here. It's just like, bonds. I don't like bonds, right? They don't go anywhere. I want return. I'm all about risk and return. Anyways, this is the chart, and we can see, the cash flow ETF did quite well, actually slightly outperforming the S&P 500 and definitely outperforming the defensive allocation over this time period. Now, let's take a look at the Sharpe ratios here. Which one had the highest risk-adjusted return? It was actually the S&P 500. Very interesting. And then it would be COWZ, cash flow, and then the defensive allocation, bonds, negative Sharpe ratio during this time period. Now, what I want to point out here is look at how much downside the COWZ ETF had. It actually had the highest drawdown. It had a higher drawdown than the S&P 500 at 27.84 versus 23.95, slightly higher drawdown. Also had a period of underperformance, and it wasn't until we got into 2022 where it really started to kind of shine and outperform. And then, compared to that, the lowest drawdown portfolio here of equities was the defensive allocation here. What else do we have on here? Portfolio 1 is the defensive allocation. Oh, portfolio 2 is the bonds, right, with the negative Sharpe ratio. It'd be nice if I renamed these, but I should have started doing that before so we could look at it. The big thing to take away here is that we can see in the blue line for the defensive allocation, it's been relatively stable with the lowest drawdown among all of the equities. Now, let's just kind of change this up in time period here and look at things since 2021. So that'll be 2022, 2023, 2024. Actually, yeah, we'll do 2021. It'll be 3 years, a little over 3 years. And what we're going to see here most likely is that COWZ just rocks it, which it does, yellow line. COWZ just absolutely kicking ass here with a compound annual growth rate of 17.79. Defensive allocation at 6.47, S&P 500 at 10.74. So the high cash flow strategy outperformed during this time. Subsequently, it's important to note that interest rates were rising. That might not always be the case. And then the defensive allocation, was pretty stable during this time period. It had the lowest drawdown, but ultimately, it hasn't rocket shipped back up. So, yeah, this is pretty interesting stuff to look at. So, what is my take on this here, as far as using high cash flow investing through high cash flow ETFs or defensive allocations as the equity portion of your portfolio? Well, generally speaking, you can probably tell from the tone of this video, I like that concept. I personally do not hold any bonds in my primary investing strategy. I do have multiple strategies that may invest in bonds at certain periods of time, but by and large, I don't hold any bonds. I'm not a big fan of bonds. I like the risk-adjusted returns of holding equities. Now, that said, where do you get where does the conservative play fall into it? We do need to be conservative. A lot of us do in some capacity, right? Should it be defensive allocation or high cash flow? Well, here's the real tell on them, and let's kind of pull the timeline back. High cash flow investing provides diversification against market cap weighting, right? And that is over the long period of time, right? So when interest rates are rising, the high cash flow looks good, right, compared to market cap weighting. But at the same time, it comes with relatively high volatility for what it is. And that's because it can constantly change, or every couple months, every quarter, I think is how often they change it. It can change its holdings to hold the high cash flow companies. And this makes it really susceptible to cyclical sectors, right? So if we were to break out and take a look at the holdings of the COWZ ETF, probably going to see a lot of energy holdings in there, high allocation to the energy sector. And by nature, energy is very cyclical. When oil and gas is in a boom and just printing money, well, the COWS ETF and other high cash flow ETFs are going to hold a lot of those types of stocks because they're minting money. But when oil and gas prices, are low, it's going to sell all of those because they're not making any money and invest in other things that are making cash flow. So that by nature, that kind of consistent chase of where the cash flow is coming from in the market at a given time is going to increase the volatility of the COWS ETF substantially relative to a defensive allocation, whereas defensive allocation is going to be much more stable long term and much more lower volatility, and it's also likely to have a much lower drawdown as we've seen historically. So it's really a matter of yourself and asking yourself, hey, am I doing this, because I want diversification from market cap weighting? In that case, high cash flow investing is probably the ticket. When market cap weighting is getting its ass kicked, high cash flow investing is probably going to be doing quite well. Or do I want stability? And do I want stability in the equities? And, if you're coming here because you want a diversification from bonds that may be more, for you. Or if you're, a younger person, you have a 30-year time horizon, then you may want to allocate more towards high cash flow investing because you can stomach and handle that volatility. And, I use the word stomach there, the real tell is what can you stomach as an investor, right? Can you stomach large drawdown and high volatility, knowing that you're going to have some diversification from market cap weighting and also pretty strong returns? Then you might want to consider high cash flow investing. On the flip side, if you like the lower volatility and low downside, then a defensive allocation is really what you want to play for the conservative portion of your portfolio that may be replacing bonds. On that note, that's a wrap from me. What do you guys think? What's your take? Is there anything you feel like I overlooked or left out in this video? Let me know in the comments below.